If you're a new real estate investor and you think your property is profitable, but your bank account is still tight, then this is for you. Most landlords don't fail because of bad deals. They fail because of misunderstood numbers. Today, I'll show you 4 failed mistakes that real estate investors overestimate in their profits, and exactly what to check on QuickBooks Online. Stay with me because reason 4 is where most real estate investors panic. I had a client who had 2 rental properties. She thought she was making $1,200 a month. After reviewing the books, we discovered that she missed deducting property taxes, vacancy reserves, CapEx planning, and depreciation on an $18,000 kitchen remodel. After all those deductions, it was determined that she was negative $400 a month. And that's what I call a quiet loss. So how does this happen? How does someone think that they're making money, but they're actually losing money? Let's look at 5 reasons why new property owners think they're profitable, but are quietly bleeding cash. Reason 1, you're looking at your bank balance, and this is not real profit. Looking at your bank balance is simply just cash visibility. That's like checking your gas gauge, but not checking your oil level or your tire level to make sure that they're good. So typically what happens, real estate investors, they only check their bank balance because there's no system that's needed or no accounting knowledge. So you look at your bank balance, you see that you have an available balance, and you think you have cash, that you're good. So what you do see is an available balance of $10,000. But what you don't see, owner's contribution of $2,700, the tenant security deposit of $1,500, property taxes of $4,200. Oh yeah, and that dishwasher that you need to replace, that's $325. The homeowner insurance renewal is $1,200. All of that totals $9,925. So what your profit is actually is $75. So when you're only focused on your bank balance, you take the risk of overspending, making poor investment decisions, and expenses are forgotten, which now equals a poor portfolio. So I want to give you an idea if you're focusing on just paying attention to your bank balance. I want to give you an idea of the difference between the bank balance and actually focusing on the balance sheet as well as the profit and loss. So if you're logged into your bank, it's going to show something like this. Now, I'm not logged into a bank account because I created some accounts specifically to do tutorials. So I don't have my bank account linked to this, but I do have some transactions that I put in here. So looking at your bank account, you're going to see a couple of transactions that look like this. So let's go to the reports, and I already actually have it open to your profit and loss. So one thing that you want to pay attention to your profit and loss is to make sure that your revenue exceeds your expenses. So here is our income. We have our interest income, our late fees, and our rental income, which for up to today, we have a total of $5,476.18. Now, our interest expense for paying on our mortgage, we have a total of $1,742, and then we did some repairs, and that was $12,000. So right now we're at a negative $8,265.82, which is very important because now we need to find out why do we have a $12,000 repair expense on our profit and loss. But before we look into that, let's go in and look at our balance sheet. So the things that we want to pay attention to on our balance sheet, we are paying a mortgage on our property. So if we go down to our conventional loan, let's see, we have $890,000. Let's look and see if we're paying down on our mortgage loan. So we want to go month over month. go down to our, so we're at 891, 890, 998, 89. So we are paying on our mortgage loan, which is giving us more equity on our property. Another thing that we want to pay attention to on our balance sheet is if we have reserves set up, so money set aside for emergency. We want to make sure that that it's increasing every month. So we see February was 257, and then in March it went to 1557. When you're just paying attention to your bank balance, you're not able to focus on how your property is performing. So do this instead. Instead of just focus on your bank business, I want you to at least do the basics of bookkeeping. That's tracking expenses, your income, payments, reserves, and owner contribution. Reason number 2, you're mixing personal and business money. This simply means that you're using one bank account for both personal and business transactions on your business account. That's like mixing both dirty water and clear water together. One is going to impact the other one, and it's hard to separate the two. So what tends to happen is it's much simpler when you have one statement, one bank card, and you can use it for everything. But what happened is now you run into a negative net income, you have a negative equity, and you reduce your operating cash. If you are mixing personal and rental money, I want to give you an idea of how that looks and how we want to make sure that we keep it separated so it's not impacting your financials. So for an example, I am an investor and I have a partner. I am excited that we are doing really well, and so I want to treat myself and I want to pay for a new car. So as you can see here, here's my expense where I have purchased a brand new car. Now, typically what happens is it gets categorized as an expense. So let's put this as an expense and see what happens. Let's say vehicle expense. Okay, so we bought us a new car at Toyota by mistake, and we're putting down $15,000, and that's on March the 10th. So let's take a look at our profit and loss and see what happens. So we want to change this and look at this from year to date. Okay, and 15,000 right there. Wow. Look at our net income. We already up to date. Our rental income is $5,401.03. So this has severely impacted, along with this 12,000, and we're going to get to it, and I'm going to explain why that's incorrect as well. But whenever you use personal of your business account, and now it needs to be categorized, so we take it off the profit and loss because it is not an expense for the business. Now what we have to do is make sure it's categorized correctly. Instead of this being a vehicle expense, we have to now categorize this as owner distribution. So let's go back to it and make the correction. And that is going to be an equity. Let's say I'm going to be partner 2 and save and close. Okay, so now that we've taken it off our profit and loss, Okay, so it's not there anymore. Let's take a look at our balance sheet, because that is equity, that is an owner distribution, that was a personal expense, so it should be taken off our balance sheet. So if we go down to equity and then partner 2, you can see right there, there is that $15,000 card that I put down on from Toyota. And so that's the difference when it comes to using personal with your business. It can impact your profit and loss account if it's not categorized correctly. And then depending on what your equity balance is, so the equity balance here is this 621 because of my partner having this much balance. But if it wasn't for that, and say it was a lesser amount, that 15,000 could have made this negative. So we definitely want to be careful when we're using our business account for personal needs. So do this instead. While you just have a personal account, take a spreadsheet or a notebook paper and track all of your business expenses. Then go and set up an LLC and an EIN. Once you have your documentation, go and set up your own business account with a separate debit card. Take business transaction that you had on a spreadsheet and upload it to QuickBooks Online. So now you have split up your personal from your business. Reason number 3, you're treating big repairs like small expenses. This simply means that you're tracking all of your transactions and categorizing them as expenses. That's like replacing your car engine every time you get an oil change. So what tends to happen is because you're lacking bookkeeping knowledge, you don't know the difference between capital improvement versus repairs. Capital improvement are funds used to increase the life or value of the property. New roof, a water heater, HVAC, or total rehab will be all examples of capital improvement, and it appears on the balance sheet. For repairs, this is going to be when you're fixing something that is broken or a malfunctioning item, such as your toilet, garbage disposal, dishwasher, and this appears on the profit and loss. Whenever you treat your big repairs like small expenses, you risk the chance of having a negative profit loss report for months. So when you're treating big repairs like small expenses, if it's not categorized correctly, you can impact your profit and loss and your reports, your balance sheet. So for example, we have this $12,000 repair and maintenance. Let's take a look at what this is. So as you can see, this $12,000 cost comes from Jack Roofing. So whenever there is funds that go towards your property and it increases the value, that is an investment and not an expense. And as you see, if you're categorizing as an expense, it can impact your profit and loss. So the way that it impacts the profit and loss on this report, as you can see that right there, we have a negative $8,265.82. This is not an expense. This is an investment. So what we need to do is categorize it as capital improvement, or it's already listed in our chart of accounts as CapEx. So I want to change this, and this is now coming from an expense, and now it's being categorized correctly as an asset. So now when we take it off our profit and loss and we now move it to our balance sheet, as you can see, we no longer have that negative 8,000. We have taken off that expense and moved it over to our balance sheet. Okay, so we have now categorized this as CapEx or capital expenditure, and I want to show you where it's located. So as you can see, as of March the 10th, we had roofing replacement again for $12,000. So we have now moved that over to our balance sheet to increase our investment total. So as you can see now, we have a total of $24,000 in assets. If you're doing home improvements and you're using funds that's $2,500 or more, you most likely can categorize that as a capital improvement. Anything less than that you're fixing or is a malfunction, we can most likely categorize it as a repair. Reason number 4, you're not reconciling your accounts. This simply means that when it comes to your business bank account, you don't have a second source such as a QuickBooks Online balance to reference and to make sure that they're matching. So when they're not matching, that's not reconciling. That's like paying for food without looking at the receipt. You don't know if you paid too much or if you paid the exact amount. So what tends to happen is you're unaware of what's outstanding. For example, that check you wrote to the contractor, you don't know if he's had time to deposit it, if it's cleared the account. It's the first of the month. Have you received all your rental income from your tenants? Or maybe you made a payment for the mortgage with using ACH. Sometimes that can take 2 to 3 business days. You need to make sure that you're tracking all of this to make sure that it has cleared the account. When you don't reconcile, your cash flow is wrong, profit is wrong, your equity is wrong, and the financial decisions that you make are most likely going to be wrong. So here's what I want you to do instead. Look at your bank balance. Make note of the available balance. And then any expenses that you make, specifically in ACH, writing a check, or maybe your rental income, make sure you're specifically writing those down and checking them off when they clear your account. Once they clear your account, as long as your book balance matches what you see on your bank account, then you have reconciled your accounts. If you're a new real estate investor, if you feel unsure about your current books, or you haven't been doing bookkeeping, then this is for you. I offer a financial diagnostics. Feel free to schedule a consultation. I'll review your profit reports, bank balance, expenses, owner contribution, reconciliation status, and I show you exactly where you stand.